Hi, Steve here from Promise Money, and in this short video I'm going to talk to you about tips so you can get the best out of asset finance, so that you understand what lenders are looking for, and therefore when you come to applying, you're set up as well as you can possibly be. Firstly, let's just talk about what is asset finance. Well, it is a loan secured against an asset, and it could be being rented to you. You could be buying it, or it could be something that you already own. There are basic different categories of assets. So we've got hard assets, which are heavy equipment, plant machinery, cars and things like that. We've got soft assets, which are more, I guess, movable to some regard, and less easy for a lender to tie down, and that could be things like office equipment, IT equipment and things like that. Scaffolding, there's another good example. And then we've got other more specialist assets, such as your debtor book. The people who owe you money, that is an asset, and lenders can secure loans against that. Your inventory, for example, if you're a car dealer, you could have stock finance. And even intellectual property. So there's lots of different sorts of assets, but most of the people who will be watching this will probably looking at buying an asset, because you can either take out asset finance to purchase the asset, or you can refinance an existing asset. And they're two very different products. Refinancing an existing asset, let's say you own 10 lorries and there's no debt on them, you refinance all of those, that releases cash into your business so you can use it for cash flow. So they're two different scenarios. So let's just talk then quickly about how lenders are going to be looking at you. And it's a box ticking exercise, really. What they're going to do is look at a number of factors and say, do you tick that box, that box, that box, that box? And if there's 20 boxes to be ticked and you fail to tick one of them, some of those lenders are going to say, you've not ticked the box, you're not for us. So really what you want to try and do is tick as many boxes as you can. That gives you more choice of lenders, and that means that you're going to get potentially lower rates and a better deal. So what are the main boxes? Well, the first thing is going to be your bank statements. Most lenders are going to look for 3 months bank statements, some 6, but in those bank statements, they're going to be looking for, have you missed any payments? So direct debit. Have you got an overdraft and you've exceeded the limit? That's not a good sign. That worries lenders. They don't want to see they don't want to see businesses which are struggling to manage their existing cash flow. Or are there debts being paid to HMRC? For instance, have you got a big tax debt and you're now paying on direct debit to HMRC, and that's showing up on your bank statement? So the first thing to look at is your bank statement. Say, right, how good do we make these look? Make sure there's no missed payments, make sure you're within your overdraft, and make sure that there's nothing showing that suggests that you are under an arrangement to make your tax payments to the HMRC. Those are the three biggies. So if you're watching this now, look at your bank statements and thinking, oh crikey, it might be wise to say, well, let's take the next 3 months to try and sort that out, so you can then provide 3 months good bank statements. Secondly, your latest filed accounts. The lender's going to want to know that your business is profitable, so they're going to look at the profits. They're going to consider how much you might need to take out as a director, but they are going to be looking at your profits to make sure it's profitable. And if your accounts are 6, 7, 8 months, even a year old, they're going to ask for your management accounts as well. So think about how you'd be able to provide that. Most businesses these days do their own management accounts on something like Sage or Xero, and you can press a button, get an export, job's done. But you need to think about how you make those accounts look as good as they can possibly be, i.e. profitable. And you've got a positive balance sheet. So if you've got lots of debt, that's not going to look so good for you. So that's the next factor. The next point is a biggie, adverse credit. So the lenders will look at the credit profile of you and of your business. Now, if you've got a couple of little missed payments on something, that's probably not the end of the world. If you've got court judgments and defaults, either personally or against the business, for a lot of lenders, that's a big no-no. If they're satisfied, it helps. And there are lenders ranging from squeaky clean applications through to ones which maybe aren't quite so clean. So we've got a choice of lenders to go to, but you want to try and get yourself into the place where all the lenders are keen to do business with you. If you've got adverse credit, it's best to try and get it settled, and there needs to be a good story behind it. we can then go to appropriate lenders depending on what that situation looks like. So your credit profile is good. And then the other factor is your profile. If you've got a little bit of adverse credit and a lender might say no because of that, we can try and mitigate that by saying, yeah, look, we know there's some adverse credit here, but look, we've got a really strong client, very experienced, good asset background, owns his own house, loads of equity, maybe owns some buildings as well. And we've got a really strong set of accounts. So our job is to take all of these factors and argue the case on your behalf. If there's something over here which isn't so great, we've got to try and find the positives. That's what we look to do. We've got to try and find the positives to offset any negatives, so that we can open up the net. I mean, there are lenders, for example, who will lend to you if you've got a strong asset background. There are other lenders who will lend to you if maybe you're not a homeowner and you don't have a strong asset background, but they're going to look more at the business and the credit history. There are even lenders who will lend to foreign nationals and they're not UK residents, provided they've got a strong background, i.e. the business has been trading a decent while and they've got a good profile, a good credit profile, and they've got on the voters roll for many years in the UK. So the number of lenders available is wide, but the more boxes you can tick, the better. So expect to provide the following to the lenders. Details of your assets that you're looking to buy. What's it going to cost? What's the make? What's the model? The full details so that they can do a valuation on it. They will want to get a good, clear idea of what it's worth now, and also assess what it's going to be worth in 5-6 years' time, potentially when the finance agreement comes to the end. They're going to want to know 3 years address history for all directors, date of birth, and full names. And it's directors and any shareholders who own more than 24% of the business. So they're going to want to know about all of those people. So gather that information together. They're going to want 3 months business bank statements. Some might want 6, but generally 3 is enough. So we've talked about that. And then the other part, and this is again part of our role, is to build a profile. They want to know the background and the rationale for everything you're doing. So if you are buying some plant and equipment, why are you buying it? How's it going to benefit the business, so they understand that. And as part of that whole synopsis, we would then build into your asset background and pull out all those positives that I mentioned to make it look as possibly as good as it possibly can. Other things for you to think about during the application process is going to be, how long do you want to take the finance over? What sort of deposit do you want to put down? Now, deposit's important because the more deposit you put down, the less the risk there is for a lender. Imagine applicant A comes to them and says, I want to borrow £50,000, I'm going to put no cash in, I want to borrow 100% of the purchase price of this particular asset. And applicant B comes along and says, well, I only want to borrow 25,000 secured on that asset. I'm going to put £25,000 in myself. Then the lender's going to say, well, we're going to give you better terms than we're going to give this guy, because clearly our risk is halved. So the deposit you put in at the beginning is an important factor. But it's not the be all end all. If you haven't got the cash, then we just need to know that. But be aware, the more you can put in, potentially the better deal that you might get. Another thing for you to think about is the balloon payment. With asset finance, there's the ability for you to pay all of the interest as you're going through the loan. So if it's £50,000 over 5 years, you're paying it all of that during the term of the loan, which means your repayments are up here. Or you might say to the lender, actually, I'd like to keep my repayments lower, and I'll have a balloon payment at the end, which means that when you come to the end of the term, when the asset is sold, they take that interest off at the end. So let's say it's a £50,000 asset, and you're going to pay interest on £25,000 and balloon payments on £25,000. That means your repayments are lower, and there's a balloon payment at the end. These are options for you to consider. We can help you with all of that. And then another factor is VAT. Is the VAT on the item or is it no VAT? And just be aware that if there is VAT, that's got to be paid when you buy it. But there is an option with most lenders to add the VAT into the loan. So if they give you the loan, in some cases, even if it's 100% borrowing, the VAT can be on top of that. And then you claim the VAT back in 3 months and repay that part of it. So VAT is another element. Some options that you also need to consider are personal guarantees. If you're not familiar with personal guarantees, this is you personally saying to the lender, if this all goes horribly wrong, I guarantee in writing that I will make good. And that means they can come after you for your personal assets for you to make good on that. Now, some people say, well, I'm not going to give a personal guarantee. And the flip side of that from a lender's point of view says, well, if you're not prepared to take the risk, why should we? Especially if you're looking at 100% borrowing. So personal guarantees aren't absolutely mandatory, but be aware that lenders like to offer personal guarantees. And if there's a few mitigating issues in there, a few issues in the application, they don't like the asset, or your credit's a little bit iffy, or you're not a homeowner, but you've got some other assets, offering a PG makes it easier for a lender to say yes. It makes it easier for a lender to say yes and offer a better rate. So it benefits you to offer a PG in the long term, provided you're intending to make all the repayments. The downside is if you don't make all the repayments, then that debt comes personally back on you. So it's something to think about. And again, we can talk. We talk to our clients about that as we're going through the process. I'll just finish with just quickly different types of asset finance. You've got hire purchase, where you basically spread the cost of the asset over a fixed period, and you've got the option to own the asset outright at the end of the term. Or you've got a finance lease, which is a little bit more rental rather than a loan, but it works. I guess what I'd say is don't worry about that option, which option you go for at this stage, because most lenders offer both. It's really what's going to suit you once we've narrowed it down to right which lenders are going to play, who's going to give you the best deals, etc., etc. So to summarise, bank statements, let's make sure they're as good as they can be. Your accounts, let's make sure they're as good as they can be. The asset, you can't really do much about that. If you're buying an asset, it is what it is. If you're looking to refinance an asset, what are the options, or what are the most attractive assets? That's something we can talk about. Your profile, your background, so your business experience is important. The strength of the business and the accounts of the business is important. The lenders want to see all of those things. And of course, credit history. Hope you found that helpful. Hope that helps you get your head around what you need to do to get the best possible options for asset finance. In closing, please don't forget to subscribe to our channel. Please do like this video, share it if you can, if you know somebody else who might need it, and keep your eyes out for other videos that we have already done on commercial mortgages, bridging finance, secured loans, mortgages, all sorts, asset finance, etc., etc. And look out for the next one. Thanks a lot. Bye bye.